Good afternoon, everybody. This is Dina Lucas speaking from the company Creara. I will be presenting the PV Grid Parity Monitor for the utility scale segment today, and we'll be having a look at the ninth issue of the GPM. First at the theory and the methodology behind the document, and then we'll have a look at the results in the different countries. So the GPM series analyzes grid and generation parity in several markets. As I said, this is the ninth issue of this document, and it focuses on the utility scale segment, covering 8 markets around the world. You can see here on the right side that the utility scale segment refers to an installation with a capacity of 50 megawatt peak using a single access system, and the installation is acting as a merchant plant. The markets we're covering in this issue are Chile, Honduras, Italy, Mexico, Morocco, South Africa, Texas, and Turkey. And we've taken several assumptions and inputs in order to carry out the calculations that are the basis for this analysis. The assumptions are that the installation has been financed by a project finance scheme and has a 70% debt ratio. And we've used real market data from EPC companies for different inputs for the model, and we've prepared P&L and cash flow accounts that represent the perspective of the PV investor. On the left side, you can see a map of all the countries that have been covered at some point in one of the GPM issues. The ones marked in red are the ones that I just mentioned for this issue. You can see there which location within the country we've chosen for the analysis, and the blue dots represent those countries and those locations that have been covered in previous issues. So let's have a look at the theory behind the GPM utility scale. The document analyzes generation parity of PV installations, and generation parity has been defined as the moment when profitability requirements of a PV investor are completely fulfilled with the wholesale electricity price. This means that the cost of let me just get the pointer. The cost of producing PV electricity while taking into account the profitability requirements of the investor. This has been calculated as being represented as the green line here on top as the required PV tariff. This tariff is lower than the reference price in the wholesale market. You can see here that on the left side of generation parity, the electricity from wholesale markets is cheaper than PV generated electricity, so the PV investor actually needs some further incentive to invest in this type of installation. This could be a feed-in tariff, a tax credit, or similar. While on the right side of this point of generation parity, the PV generated electricity is actually cheaper. You can see here the green line is lower than the red line. So actually the required PV tariff, the minimum tariff that the investor would have to receive to make this investment profitable from his point of view, is lower than the electricity from the wholesale market. And so the investor could actually obtain profitability. So let's have a closer look at the required tariff. The required tariff is calculated as the theoretical rate with which the PV investor would achieve at least the minimum profitability sought in order to build the PV plant. And for this calculation, basically we have real market data for the initial investment, operating expenses, and the debt costs, but we're still missing the part of the income. So we can calculate how much the PV installation produces, but we have to calculate what tariff would be necessary, so what income per production unit, the kilowatt hour, would be necessary in order for the investor to consider this investment as attractive. And in order to calculate this required tariff, we've taken into account the internal rate of return, which has been set equal to the cost of equity for the PV investor. This basically was done because it's considered that this is the minimum return that the investor would ask for when investing in this type of installation. So we have the reference price on, the required tariff on the one side. Let's have a look at the reference price, the one we're comparing the required tariff with. And the reference price is used as a benchmark for the potential income that the PV investor could obtain from the market in each of the countries. And there are several options for this reference price. The first one would be the marginal price of the day-ahead market in the power exchange. And another one would be the price of PPA contracts, which are negotiated freely on the liberalized market. The problem with PPA prices are that they are usually not public because they are private contracts. And so for this study, we've decided to use the marginal price on the day-ahead markets where possible. And in those countries that do not have a spot market or power exchange, we've decided to use the regulated tariff for large consumers because we believe that this would be the upper boundary for a PPA contract. So no large consumer would be willing to pay more for the electricity than the regulated prices. You can see here on the left that we've used the nodal price in Chile as an example, and you can see here how the prices have changed in the last years, the semesters we're looking at. And for the study, we've taken into account the daylight hours. These are represented here by the red line. So we've really just considered the prices during those hours that the PV installation could be generating. Depending on the country, this starts at an earlier point and then finishes at a later point during the day. But we're not taking into account the prices during the night. And you can see here that the average prices for the daylight hours are a bit different from the normal average prices, taking into account all prices during the day. So let's have a look at the results. You can see here on the graph that only Chile and Morocco are in full generation parity. Chile is over here, Morocco over here. Although Honduras, Italy, and Mexico are or have been closed recently. You can see that they are close to this second area. By close to generation parity, we consider a required tariff that is not more than 50% higher than the reference price. You can see on this graph where we're comparing the results from the first issue of the GPM utility scale, which was published in 2014, and the results from this issue. And you can see that the required tariff, as marked on the low axis, has decreased in all cases, and so have generally the reference prices, as marked here on the upper axis. And yeah, basically the initial investment costs for all countries which are considered in dollars have decreased in the last semester. But you will see when we look into the results on a case-by-case basis that the strong dollar has actually eliminated these impacts on the final results. So let's have a look at the countries. The first one, Chile. In Chile, the reference prices are above the required tariff for the PV investor. Nonetheless, the reference price has decreased considerably since the previous issue. You can see that by the very marked drop between the beginning of 2014 and the second semester. Generally, in Chile, the high electricity prices and the extraordinary irradiation level contributes to the full generation parity in the Chilean region that we're considering. But as I just mentioned, the prices have dropped significantly, and generally the market has shown quite high volatility rates in electricity prices. So even though the required PV tariff still has some margin to grow, and the reference price has some margin to drop, the margin that we analyzed in the last issue has decreased significantly. Honduras. In Honduras, the PV utility scale generation is not competitive at this moment, although you can see that the required tariff is quite close to generation parity. It was about 30% above the reference price. In Honduras, you find quite attractive irradiation levels compared to other countries, but they're very high CPI rates and the capital costs are very high. The government actually decided to promote solar installations, and for installations that were connected to the grid by the end of August 2015, they offered an additional 3 cents per kilowatt hour incentive that made the installation move, or these installations move very close to generation parity. Here in Honduras, we use the marginal short-term generation cost as a reference price because no spot market exists. Italy. In Italy, the PV utility scale generation is not currently competitive in the spot market, although by the end of 2013, a close to generation parity situation was actually reached. You can see that here by the little peak in the reference price. Generally, the reference prices have decreased in the last years. You can see that it's been decreasing by about 12% annually. But the high cost of equity and the taxes for land renting have been a barrier to generation parity for installations in Italy, which have actually achieved a decrease in the required tariff of above 8% per year. On top of that, the Robin Hood tax that had been enforced since 2008 was eliminated in 2014, so the conditions for the electricity producers have actually improved. In Mexico, generation parity was actually reached in 2012. 2012 and the first semester of 2013. You can see here on the left side of the graph that the reference price was above the required tariff, but the very strong decrease of the reference price by about 30% annually between the beginning of 2012 and the beginning of 2015 have led to a required tariff that is actually quite far from the reference price. So we've seen a negative trend in the situation in Mexico, and generation parity is not a reality in this country at this point. Even though the required tariffs have been decreasing on an average of 1.5% per year, clearly the reference prices have decreased more. The energy reform that has been announced in the last year is still underway, and so the evolution of the situation in the country should be reviewed more or less on a regular basis, because the situation for PV installations could change significantly. Morocco. Morocco has reached generation parity. As you can see here, the required tariff is actually below the reference price. The difference between the two is not too high, but you can see that definitely the required tariff is covered by the electricity tariff for industrial consumers. In Morocco, there's no spot market, so we've used this as a reference, as a benchmark. And actually, the reference price has been constant for the last years, no changes there. Although it's planned to increase in several steps until 2017, and therefore the generation parity situation could even improve further, especially since the required tariff is on a downward trend. You can see here that the required tariff has been decreasing by close to 12% per year. South Africa. South Africa has actually very high irradiation levels, but the required tariff nevertheless is far from generation parity, and this is mainly driven by the low wholesale electricity prices. You can see here the reference price is actually below 3 euro cents per kilowatt hour. And even though the reference price has been increasing on average by 10% per year, the required tariff, looking in the long run, even though it's been decreasing since the beginning of 2014, has been on an upward trend if we consider the time since the beginning of 2012. And yeah, this probably should be reviewed further as well to see if this downward trend of the required tariff will keep going, and to see how far it actually drops. In Turkey, PV technology is not competitive in the utility scale segment at this point. Although the wholesale electricity prices cannot be considered low, and the required tariff is decreasing. You can see here in the graph that in Turkey the required tariff has been decreasing by about 1% if we take into account the time spent from the beginning of 2012, and the reference price has done the same. So it's actually been decreasing a bit faster than the required tariff at over 3% per year. And basically the CPI rate in Turkey is expected to stay on a similar level, and so we believe that in the midterm the investment case will not change too much. The same for the high discount rate, which is the high return that the investors ask for in Turkey, can be considered a barrier to the PV generation parity. In Texas, in the United States, we've considered Texas as a case study. Although in Texas the required tariff for PV investor actually has been quite low, it's been below $100 per megawatt hour, which is one of the lowest that we've analyzed in all the countries. You can see that the generation parity is still distant. The required tariffs have decreased by close to 10% per year, especially in the last 2 semesters. You can see the downward trend. The problem is that the reference price has done the same. In the last issue, we mentioned that there was an upward trend in the day-ahead market prices between the beginning of 2013 and the beginning of 2014. But this trend actually was not confirmed in the last 2 semesters. And you can see here that the reference price has decreased significantly. In Texas, still there are PV installations being built, and this is mainly because the PPA option might actually allow PV investors to obtain profitability with this type of investment. So to summarize the main conclusions of this GPM issue, the results of the GPM analysis show that only Chile and Morocco are in full generation parity, although as we've seen, Honduras, Italy, and Mexico have been closed recently, although each of them in a very different situation. Given the volatility of the wholesale market, the fast decline of the PV prices, we've seen that within the utility segment, the prices are actually decreasing a lot faster than in the residential and commercial segment, as well as the ongoing regulation reforms actually require constant reviews of the situation for PV installations in these countries. And so we think that this is something that should be reviewed within the next couple of years. We would like to point out that even though the fact that generation parity has not been reached in the country, as indicated by the study, does not imply that utility scale plants will not be built. This is mainly due to different reasons. As could be, for example, some type of investment incentives, for example, a renewable portfolio standard, feed-in tariff, or a PPA scheme that is attractive for the investor. As I mentioned before, the required tariff that has been calculated in this report is actually based on a project finance scheme, and we believe this is currently the most common form of financing this type of installation. It would definitely be interesting to consider other types of financing which could improve the generation parity results in different countries, but here we're really just focusing on the financing scheme. And just to finish, we are working on new GPM reports, including the 3rd edition of the utility scale, which should be issued next year. And here on the last slide, you can see a summary of the different issues of the GPM in the residential, commercial, and utility scale segment that have been published so far. And you can see here on the right that we're planning on publishing the commercial segment issue in May 2016, as well as the utility scale issue in July 2016. So by then I'm sure we will find some more interesting conclusions on the situation of PV installations. And yeah, we'll be back for another presentation then. Thank you all for listening.